Give it a minute or two. All right. Well, today we're going to be talking through valuations and market cycles, and so it's I think two topics that are very large, very significant, and that have even a bit of controversy around them. But quick introduction first, in case you don't know me or haven't heard of me before. Basically, a research professional. Started my career in investment management, and then decided to go out on my own and start Top-Down Charts. And so it's a pure, 100% independent, pure investment research firm. And that kind of reflects my chosen career path too, to focus on research. So. I don't do any trading or investing myself. My job is to do the analysis and then go and um, partner with portfolio managers and basically provide them with the best analysis so that they can focus on being the best portfolio manager. And there's a few reasons for that. The more that you focus on your specific skill set, the better you get at it. But also, the moment you start trading, investing, your independence kind of trickles away because you get wedded to the positions, and it definitely plays on your mind even if you are completely transparent about it as you would be. So that's that. But yeah, and basically top-down charts, mostly working with institutional investors, but got some retail offerings as well in terms of, for example, an entry-level version of it. But more onto getting into the context and topic of the presentation. So before we dive into what we mean by valuations or cycles, I thought it would be useful just to start off with kind of my process, or how I look at the world of macro and markets. I generally tend to start with some kind of valuation anchor. And now, just for probably best to clarify at this point, when I'm talking valuations, and this is something that we always need to clarify, because when we're talking about markets or investing, I've seen probably at least 100 different ways of approaching it from a professional standpoint in terms of managing money. And so, you could actually, and I've been meaning to put this exercise together, but you could actually get, 20 people around the table, all different types of investors, hedge funds, asset allocators, insurance companies, market makers, traders. You could sit them all around the table, and they could all basically make, a trade, and actually from each of their perspective be winning. Because normally we think of markets as a zero-sum game, and in the aggregate it is, but uh, you know, we're all coming at it with a different time frame, a different objective, goals, purpose, constraints, regulations, etc. But the way I approach things is basically looking at it from a multi-asset investing standpoint, and so when I'm talking about valuations, I'm thinking of things like the PE ratio. And so the reason, and that would be on the index level, or the asset class level. And so the purpose for me for a PE ratio is not to say, oh, this stock versus that stock. And I wouldn't be looking at, for example, and I don't mean, when I say valuations, I don't mean like a discounted cash flow model, which a stock picker would be using and should be using. But where does valuations fit in anyway? So I would start by looking at valuations as an anchor. It helps prioritize what asset classes to look at, identify risks and opportunities. But then you can't stay there, because, as we'll quickly find out, the signals that you get from valuations, they can be prone to providing frustration, or requiring patience. But even when you have the right setup, the right signals, and etc., you still need to bring in these other factors like cycle indicators, and that's what we're talking about there. For in the equity context, it would be earnings, macro, monetary, definitely, and then rounding that out. So once you've kind of got the core kind of fundamental thesis together, it would be rounding that out with tactics, and so that would be thinking of things like bring in sentiment analysis, technical analysis, flows, positioning. anything that helps raise conviction on that existing view that you have to help with the actual timing of that. And so, in broad terms, it's really about putting together puzzles. So, from my point of view, I'm not dogmatic and pragmatic. So any piece of the puzzle, any puzzle piece that I can find that helps build the picture is going to be helpful. And then, just on the side around that, you don't need every single piece of the puzzle to get the picture. Sometimes you just need a few, but you need enough pieces of the puzzle to stop yourself, overfilling some of those gaps. But getting into the some of the core concepts here, I think if we think about the way markets work, it is an enormously complex thing, but you know, to figure out the best way to navigate it, you have to start by oversimplifying it. And so this is what we've got on the left there. The simple version of the cycle is that you have this kind of it goes up, it goes down, and it goes up again. And this is around a straight line, and sometimes we do get that where it goes up and down in the cycle around a straight line, but oftentimes it's around a trending line, which I'll show you in a second. But the idea there is that the conceptual model of a market cycle would be that it goes very high, gets expensive, and then for whatever reason rolls over, goes down, gets cheap, provides buying opportunities, and then ultimately turns around, usually prompted by something. The sort of more nuanced or real world version of that, it's because yeah, we start by oversimplifying it to produce a conceptual framework to help us uh, make indicators and navigate the thing. But then going through the thing, this is often the journey of the actual investor is that you in that late stage of the cycle, it's expensive, but it's still going up. You have short squeezes, you have peer risk. So, you might be like, well, it's expensive, so therefore we want to pull back, but then your peers are still all in and they're outperforming you. You fear of missing out, all these bad things. So the zone of max risk for long only investors is that point at the top there where it's expensive, but where is the precise top? The best part, in terms of managing risk or maximizing productive capture of the downside, for example, could be in the simple terms, it could be just going to cash or underweighting equities, or it could be other things like shorting or using some kinds of derivatives. But that's the best time there is once it goes to extreme expensive and then actually turns the corner. Because picking as a sort of hinted at there, picking the exact top is quite a treacherous pursuit. But then you get to this, and then things continue to unfold. You get to the point of least signal where it's neutral, but the momentum is down. And then you get to this dangerous point where it's cheap, but the momentum is still downwards. And then another dangerous point is when it's cheaper yet, but you're basically in the value trap zone because cheap can still get cheaper. Then you have ultimately you get the bottom, and then the best value driven buying point is just a little bit after the bottom. So and then running over to the other side, you basically repeat the whole thing again. And then also wanted to share this one, which is quite interesting. Basically, so we had the conceptual thing of how it works here, and this is some real world analysis of what valuation extreme cycle peaks and troughs look like. And so, just to clarify what I mean by that, this is peaks and troughs where there was a valuation extreme. And so, for example, 2008 is not included in that in terms of market peaks because it wasn't a valuation extreme. It was slightly overvalued, but it was basically, what caused that downturn was something else entirely. Um, it- Whereas, for example, the dot-com bubble peak was obviously, like a prime example of this. Also, the 2021 peak. And so there's a couple of things to note about this. First one would be the frequency. So this is covering a period from 1910 to 2024. So, over 114 years there. And you've got eight peaks, 12 troughs, and that's what, one every tw 6 years kind of thing. So, you know, if you think about the market cycle being about 5 to 10 years, it kind of lines up with that. But also, just it is a relatively rare thing. So these opportunities, risks, they're probably going to come along once a decade. Doesn't mean that, we should ignore them by any means. It means that, th these are going to be major opportunities to either build wealth or protect wealth. But another thing that I thought was quite interesting to note is, in terms of comparing and contrasting the concept versus the actual how it unfolds is, so if we look at the typical top, valuation extreme driven top, it's a deceptively smooth ride on the way up, and then it turns generally tends to turn very quickly and sees a lot of the downside in the initial year there. And so, yeah, just to be clear too, this is looking at uh, the it's monthly data, looking at the 3 years before and after the peaks and troughs. And then, the other interesting note there is that it tends to see a higher plateau or higher range afterwards. In terms of bottoms, though, they happen, the market tends to fall slowly at first and then all of a sudden. And then in the rebound, you get the sharp initial rebound, which basically slows as you move on. So in terms of parallels to today, I think it's also quite interesting because we are in the middle of what is, by all accounts, a pretty smooth and steady ride up and into expensive levels. But we'll talk about the current situation pretty soon. The other thing to note, and I've kind of hinted at this before, is that cycle model is, it's kind of assuming that markets undergo this sort of long range trade and they don't go anywhere, but that's not how things work in practice, is that you have these periods of uptrends as well. But even when you have these uptrending markets, is you have this cycle around the trend. And so if we look at this valuation indicator here, you can see that within that uptrend in the 50s there, you had that initial that peak there, which it wasn't a catastrophic downturn there, but any time that you can protect downside a bit, but also once it's ran its course, look for opportunities to get back in within a trend or increase exposure within an uptrend, and it's also quite value adding. Um, and then, but also though, there are actually plenty of examples of long-term periods of basically large range trades. So, for example, the 60s, 70s, and then throughout the late 90s to the 2010s, if you zoomed out enough, it's basically a big range trade with, and that's the kind of like where valuation indicators for investors really prove their value in terms of navigating those cycles. And so to round it out or refine the whole mental models aspect, the refined model would be it's basically momentum through the range and contrarian information at extremes when it comes to thinking about these valuation indicators to figure out where we are in the cycle. And yeah, I mean that's the key model to think about in terms of how to think about the cycle and also how valuation indicators evolve through the cycle and then how to basically what to do with them. And then briefly also that we have these cycles across a number of different assets and again this is thinking about what actually makes cycles in the stock market is you've got the business cycle, financial cycle, supply and demand cycles. And then seeing that how these cycles unfold across other asset classes as well, that kind of just echoes and reinforces that. So in commodities, it's the same thing, but at the peak of the cycle, it's you'd still have this situation of it being expensive, but in contrast, it basically that's sending a signal to producers to invest in more supply, and so you have that fundamental reinforcement of the cycle, and then at the cheap levels, it's basically telling producers to cut back on supply, and that helps create the conditions for the rebound. Credit spreads, so this is kind of like the inverted version of the stock market cycle. So at the when credit spreads are very low, so the spread between corporate bond yields and treasury yields, that's when you would basically consider credit risk premium to be too low or credit to be basically expensive. And so that would be when the economy's booming, sentiment is bullish, maybe too bullish, stock's expensive, and credit risk, historical credit risk is low, but forward-looking credit risk may be a different story. Complacency is the overall pictures there. And then you move on to the next phase where something basically triggers it to go higher. So, typically the usual thing is something like policy tightening, the economy weakens, you have that shift in sentiment, and stocks usually going to fall then. And that's when credit risk is highest. That's realized or current credit risk. But that's when also you tend to be actually correctly or ideally overcompensated for taking on credit risk, which is the point of the cycle where nobody wants to take on credit risk. And that's actually you know counterintuitively the best time to take on credit risk because that's when you would look at credit as cheap. And then ultimately, it turns the corner as policy stimulus usually comes along, the economy starts to recover, sentiment snaps back. You know, realized credit risk is probably still high because you've probably got defaults coming through, but the outlook's improving. And then you come full circle where the economy's expanding, credit risk falls, risk-taking returns, and you're back to expensive levels. And this, we'll have a look at credit spreads shortly when we look at where we're currently in the cycle. Um, but just onto methods, so some of the practicalities of all this. Again, I addressed earlier about, when I say valuations in this context, I'm thinking about these kind of PE ratios and things. But even if you say PE ratio, there's about a dozen different versions of the PE ratio, and not all of them are good. Some of them have their own strengths and weaknesses, while others have different strengths and weaknesses. So, for example, if we look at this here, we've got the price versus peak earnings, price versus forward earnings, trailing earnings, and you can see there too, you know, real quick onto the indicator design or selection. Uh, there's really three key principles in my mind when I'm looking at what indicator to use or what information to pay attention to, as well as actually designing my own ones, is um, you want it to be explainable, and I think it's usually best to start there. There should be some economic logic for why it works, or and you should be able to explain why it works. And that kind of, well, that's important because that tells you where to look at the start, because um, there's like millions of data points out there. But it also helps you avoid falling into data mining traps where, you might go and find one that's reliable and sensible, but then it stops working because you just cherry pick the data. But it should be reliable, and to my mind, that means it works over time. So it gives a consistent signal. It doesn't work for a bit and then stop working entirely or giving wrong signals. And sensible means it should work as you expect it to. Does it actually give the right signal? And so for a valuation indicator, the litmus test on that one is when the market peaked, was it showing up as expensive? And when the market bottomed, was it showing up as cheap? And, if it's not doing that most of the time, then, you'd throw it out the window and you'd find another one. But back onto this, so which one would you select? Well, if you look at the black line there, the trailing PE, it's telling you, okay, it told you that the market was cheap, right, at the bottom there in 2009, but then very shortly after, it started saying, oh no, actually it's expensive. And that's a wrong and bad signal, and that reflects the fact that it's looking at trailing earnings. So if trailing earnings were to collapse, for example, in a recession or something like that, then um, the the maths there would mean that the price versus earnings ratio goes up, and that tells that that would not be a correct signal if we expected that earnings to recover. So the forward PE or price to peak earnings kind of helps price to peak earnings if you think about that as saying, well, this is where earnings kind of were or should have been, and they will recover. Or you can use a cyclically adjusted PE as well. But in practice, what I tend to do is take a combination of them. If there's one that's like, just outright absurd, like the trailing one, I'll just throw it out. But um, take a combination of them. And then from there, there's kind of two approaches, right? One is to say, well, I can look across these, even just here, four different indicators, and in practice, there's dozens and dozens, and say, okay, these are probably the ones that I'm just going to pay attention to. I know that uh, by themselves, they're not going to get it right all of the time. They're not going to tell me, the right information all of the time. But if I use them as a team, so I use them as different things to confirm each other, or you know, look at all these to detect where we are, then I've probably got a better chance of achieving my goal of saying, determining where we are in the cycle based on this. But the other thing is you can combine them, which is something that I tend to do as well. But I think doing both is good because, even if you were to combine them, it's still good to see what the components are doing because, again, it's about making sure that you're capturing the information and putting that puzzle together with, as many pieces as you can find. But just to go through the rest of them here too, another one is we've got the earnings yield versus cash rate there. So earnings yield is basically the inverse of the P/E ratio. So earnings divided by price versus the cash rate. And that tells us also information about the monetary backdrop, which can be quite important, but also relative value. So, you know, looking at stocks versus cash. And so that's good because that captures two types of information, the opportunity cost. So if the cash rate's really high and the earnings yield is low or at least below that of cash, then that means that you're not getting much compensation to take on equity risk, versus just sitting in cash and getting a guaranteed um, return of capital, as well as return on capital. But also, as interest rates go up, traditionally that tends to weaken the economy, sap available funds for investment, and slow the whole thing down, reduce confidence, and tends to result in a downturn in both the economy and the stock market. And then the reverse is true as well. So hence why that you would actually want to look at that kind of indicator, equity risk premium for similar reasons. And then the top right one there is basically a pure price-based one. And so that's looking at trend reversion as well as mean reversion. It's basically saying, okay, if price reflects most if not all of the relevant information, and also if price, if we, conclude that price is a pretty good proxy of sentiment and driver of sentiment, then it can act, by transforming it like this, it can act as just as good as, if not better, indicator than a quote unquote fundamental indicator like the PE. And and just to step back and kind of think about what a PE ratio is. really, it's something that would we would probably most people would think of as a fundamental indicator, and certainly it contains some fundamental information. But really, it's actually a sentiment indicator. Because if you think about it, very high valuations means that the average investor or the consensus is that earnings quality is good and earnings growth is going to be high. And from now into the future, it's basically, the more confident people are on future earnings growth potential, the higher they are willing to bid up prices. And so, that represents very high confidence, both from a mood standpoint, but also a doing, what they're actually doing. I mean, well, the opposite is true. When valuations are very low, it means that people have no confidence. They're in panic mode, and hence, and it's these extremes in emotion that push price, well above and beyond fundamentals, and then well below and overshooting to the downside versus fundamentals. And it's those extremes and overshoots in sentiment that provides those opportunities for investors who are able to both detect and observe these things as well as set themselves up to actually act on that and um, have the time frame to actually benefit from that. So you can either be a victim of the cycle or a victor of the cycle, depending on how you choose to navigate things. And it's real quick on in terms of like, how you would actually combine indicators, and also how you can basically um, create, sometimes creative indicators. So commodities would be a thing where you'd think, okay, well, there's no earnings, so we can't really make a PE ratio. What would we do? One solution that I've come up for this is looking at a few different things. So again, um, you don't want to have a million different inputs, but if you have at least sort of 3 to 5 inputs or different indicators that go into a composite indicator, you're raising the odds of having a greater signal and lower noise, or greater chance that you're getting the right signal out of it. So for commodities, what I've done is taken the real price, so commodities index deflated by CPI versus long-term average. So just assuming that commodities in real terms will mean revert over the long term, which is historically what they have done. And then relative performance of commodities versus stocks, uh, the log trend. So basically, um, if you put a trend through that chart there, the black line, it would, it's not really a traditional trend. And, if you did a trend line and you wanted to use trend reversion, so, what do I mean by trend reversion? Is if you put a line through something and it goes very high away from that line and then comes back down to that line and then overshoots way down to the downside, those could be considered expensive and cheap respectively. And um, but yeah, to be able to do that, I have taken the log, the log of that. So basically uncompounding it, and so after you do that, it actually does follow more of a trend, and it would make sense that commodities would follow a trend over time, given long-term changes in economic growth and population growth. And then, it would actually make sense that there would be cycles around that trend just based on, economic cycles and investment capex cycles in terms of commodity producers. And so, that can actually produce, deviations around that trend would be a good valuation proxy. And then the last one there is a 3-year rate of change indicator, which is just mean reversion of that. And when you put those together, you get the red line on the left-hand side there, which, as I was highlighting before, you want the thing to be looking expensive when the market peaks, which, it did. For example, in 07, 08 there. And then you want it to be saying buy or cheap when it's at the bottom, for example, as it did in 2020 there. And so passes multiple tests there and provides quite useful signals for that asset class. Now, in terms of where we're at the moment, so the one on the left there is that's my composite combined indicator for S&P 500. That combines P/E ratio, equity risk premium, and that pure price indicator. And where are we? We're expensive. If you didn't know that before, a lot of people have been talking about this, myself included. But yeah, the indicator says we're in the expensive zone. Um, Now, there's two problems with this. So, well, the immediate takeaway or the immediate reaction to that would be, okay, it's expensive, time to take risk off. And, at the margin, probably is. But then a couple of things to think about. First of all, the biggest problem is this little period here, 1987, and this other little period here, late 90s. So 1987 showed up as expensive and then crashed. Um, Now, the if we thought about that smooth progression of cycles, you might think, okay, well, when it gets expensive, I'm just gonna do the third approach. I'm gonna be like, I'm gonna sell a third when it's starting to look quite expensive. I'm gonna sell another third, when it hits the extreme or something confirms that it's peaked. And then I'm going to sell the final third when it's got real confirmation that it's rolled over and the trend's changed and all the rest of it. Um, in 87, you didn't get a chance to just relaxedly and smoothly exit. You either had some kind of risk management or diversification in place to protect against it, or you didn't, and all you could have done would be to just react on the other side of it when it got cheap, and um, increase exposure if you had actually any dry powder. But then the other one is the dot-com bubble, where it took quite a while, so it showed up as expensive, got a little bit more expensive, and then kind of stayed expensive until the thing actually started to roll over. So again, how do you manage that? How do you navigate that? Um, Again, it comes back to that first slide. So we want to have this as a pretty important pillar of our process, but it can't be the only thing. If the market's still in a strong uptrend and the things expensive and monetary's easing and economy's turning up, then it's probably going to keep going. And so, you have to kind of wait until you get this confirming data, for example, some kind of bearish divergence in the technicals, some kind of tactical indicators that are starting to show red flags. Because like if we think about the perfect setup or the perfect, picture perfect setup or set of indicators to say get out or sell, it would be the thing shows up as extreme expensive, monetary's tightening, economy data is might be good, but it's rolling over or starting to weaken. Sentiment is extreme bullish, but maybe starting to turn. Um, Investor positioning is all in, and then technicals, the trend's starting to exhaust a bit, or you're getting bearish divergence, um, an overbought signal turning over, things of this nature, and so in terms of where we're at the moment though, well, yeah, we've got that strongly uptrending market, despite the valuation signal. The economic data is doing okay, and then we did have monetary tightening, but that's turned to easing now. Um, but in terms of the outlook going forward is another story which I'll talk about in a second. But before we get too bogged down in that, let's look at treasuries. Treasuries, on the other hand, showing up as cheap. So basically, stocks expensive, bonds cheap. Stocks are expensive relative to bonds as well. So um, the valuation gap between stocks versus bonds is at the expensive end of the range. So from an asset allocation standpoint, it's also very quite a problematic part of the cycle. Yes, bonds have been underperforming, not doing very many good things. Stocks have been just going up. Stock bond ratio has therefore had a really extended run. But, when you have this kind of valuation set up, that's when you think, okay, forward-looking risk is not very good for stocks, not very good for stocks versus bonds. Meanwhile, it's good for bonds. So you would start to begin to factor that in by making some changes, or certainly um, thinking, okay, this is where this is where the tides are going, but let's think about how to navigate the waves. And the next move would be to look for evidence that says, now's the time to make the move. But also looking across some of the other assets, global equities, so global excluding US, so rest of the world, still slightly cheap. So if we think about that market cycle model from in terms of valuation indicators, we got the extreme cheap there, the buy signal, that was the trough. So we had the peak, we had the trough, and now we're in the momentum phase. Um, so it's not as cheap as it was, but we've got that upside momentum in play. So from that standpoint, global rest of the world looks good. And then from a relative standpoint, global versus US, much cheaper than usual. So, reasonable priced global equities look pretty good versus expensively priced US stocks there. And that's actually at new 20-year low there. Not quite to where it got to during the late 90s or early 90s there, but definitely enough to again pay attention and start to think about the next move and where to shift, where the opportunities are. Then lastly, also bringing in the view on credit spreads. So credit spreads are in the expensive phase of the cycle now. So is what you would also call contrarian bearish for credit and for stocks by extension, because they tend to travel a similar path. They actually just reached a 17-year low there. The counterpoint there, or the thing that you would say, don't worry, is that it might be this kind of repeat of the mid 2000s there, where they went really low and then they stayed low because it it was actually well-placed confidence in a good economy, rather than complacency against a deteriorating situation. Um, you might argue that it is on the confidence side, given that we've got kind of, at least for now, a little bit of Goldilocks of economies doing okay, and Fed is on an easing bias at the moment. And then lastly, the US dollar, so we can also apply these valuation principles to currencies. If we look at these three lines, these are all baskets of currencies versus US dollar. So frontier markets, emerging markets, developed markets. One reason I look at them that way is that when it comes to, if you're thinking about frontier market equities, for example, or emerging market equities, most people are looking at that as emerging market equities priced in US dollars. So the currency actually also matters quite significantly. So if you've got a view on emerging markets that they're cheap and the outlook is good, and then you also say that their currencies are cheap and due to turn, or the US dollars due to roll over, then that helps again in building that picture and raising conviction. But yeah, all three of those currency groups are extreme cheap versus US dollar, or another way to say this, that US dollar is extremely and universally expensive. And so, taken together, I thought, you know, in terms of thinking a little bit outside of the charts and the data, if you think about uh, US stocks as being expensive, treasuries cheap, yeah, um, US dollar being expensive, and US junk bonds or high yield credit spreads also being expensive. This is, you know, this is extreme confidence. This is price for perfection, however you want to call it. And just, reflecting on the current sort of market mood or the current narrative that's floating around the market is, you know, Trump's got in, it's going to be bullish for stocks. We're going to see a repeat of, 2016 where it kind of kicked off this new bull market there. But, to compare and contrast things, on credit spreads back in 2016, you were kind of middle of the range after this big spike, this big kind of reset versus now we're, reaching the lows. US dollar, kind of similar thing, they were kind of not at bad. And then if you look at stocks, back in 2016, you had this sort of like mini bear market and valuations were actually cheap then versus extreme expensive now. And, back then there was the tax cuts, the corporate tax cuts that were, a very real reason to be bullish because they increased earnings. This time, you know, there's, effective tax rates have already come down a lot. They're actually not far from 15% if you look at the S&P 500 in aggregate. And meanwhile, the actual proposed tax rates, tax cuts, well, do we actually see them? Maybe we do because this is the red wave, but it is going to be a little bit different this time as well because it's only going to be if producing in the US. So I think maybe not the same kind of boost. And then more broadly, if you think about a lot of the policy agenda that they've been talking about on the campaign trail is really effectively about reforms or economic experiments, and those are the kinds of things that can actually end up being very quite good. But usually when you're talking reforms, it's short-term pain for long-term gain. And so if you think about the sprinkling a little bit of macro political analysis into the mix, you've got high confidence, price for perfection, and then really quite a uncertain policy outlook. If they do go for big bang reforms, then that's the kind of thing that could actually crash the market in the short term. And then the the conspiracy theorist or the 5D thinker might think, oh, well, actually, from a strategic standpoint, we're late in the cycle. If you're the Republicans, then you actually want to crash the market now so that you can recover and have a strong stock market into the next election. Um, you know, I don't know about that, but at least thinking about the things that we can observe right now, the facts that we do know right now, that's what we're looking at in the charts. And they say be on the lookout for risks for equities. Look for any reason to reduce risk. Have one foot out the door. Have a bias to be looking for anticipating downsides, and do the opposite for treasuries. Be looking for upside. Be looking for reasons to get long treasuries. Be looking for more reasons to get into global stocks. Which, one thing that would help them would be if the US dollar peaked and turned down. That's been one of the most reliable drivers of global versus US stock performance over the long run. So, and also just, if you're not getting paid to take on risk, then don't take on risk. Ultimately that's what it's all about here. And so, yeah, just to briefly sum up, markets move in cycles. They reflect and reinforced by the underlying cycles of the business cycle, financial cycle, crowd psychology. Understanding these cycles can allow us to maximize the odds of managing risk. So, you know, avoiding downside or at least reducing downside participation and capturing opportunities. And in terms of the methods, it's best to use multiple indicators to confirm and capture the full picture, both individually and in combination. Your indicators should ideally be explainable. They should be reliable and sensible. And you ideally want to be looking at indicators as part of a wider framework, ideally a repeatable process, and the concept, and you know, overlaid against some sound conceptual models. And current assessment, as noted there, US stocks expensive, treasuries cheap, stocks expensive versus bonds, global cheap, and cheap versus US. Credit spreads, much like equities, are expensive, and US dollar also expensive. So, it's an interesting, risky stage of the cycle. 2025 is definitely going to be not boring. So with that, I'll wrap up the kind of formal part of the presentation, and we can get into a bit of Q&A if anybody has any burning questions.
Yeah, thanks, Callum. That was awesome. Very, very interesting. I did have just one question, and then we'll see if anyone else has anything as well. But you were mentioning global equities being a bit cheaper on a relative basis. Are there any particular countries or regions that you're particularly interested in at the moment?
Um, yeah, it's a good question. I mean, and I think it's the right question, but and usually there are some clear standouts, but if I look across some of the key countries there, Europe, Japan, UK, Australia, on the developed side, or on the emerging side, China, um, some of the LATAM ones, and even a bit of frontier markets, you know, pretty much, yeah, pretty much everything. So like, yeah, there might be a couple of standouts or a couple of things that are, particularly good, but I think, the real conclusion or the continued thing that I find is that it's basically everything. Um, um, which may not be a satisfying answer, but I guess it's makes things a little bit simpler as well because then you can just look at all countries, world ex US as a single way to
Mm, yeah,
express that entire thing. Yeah.
yeah. I've been interested in UK equities. They've been pretty flat for um, 5 years or so. So I think there's some opportunity there.
Mm,
Um, and then obviously Australia being based here with the attractive dividend yield as well. So you're kind of getting compensated.
mm.
Yeah, interesting.
Yeah, I was reading the questions in the chat here. See, Elon Musk and his Department of Government Efficiency cutting out 450 Fed agencies, pay down US debt, sign of downturn. Well, yeah, exactly. So this is that point about reform. So whether it's fiscal reform of like we just want to get into surplus and start paying down debt, that by itself is what we call a negative or contractionary fiscal impulse. And that's it's kind of the reverse of stimulus. So if you think about the Inflation Reduction Act and the CHIPS Act, etc., that they enacted a bunch of fiscal stimulus. And so, if you do the reverse of that, if you do fiscal tightening at a time and especially if you do it at a time where the cycle is kind of extended or, vulnerable, with being expensive, then yeah, that's the kind of thing that would be quite bad for stocks. But on the other hand, if they were doing things to improve the fiscal situation, improve the credit rating, sovereign credit standing, then that would actually improve sentiment around treasuries, and so that would actually, you know, round out that picture that we talked about before and say, yeah, actually, not only does this make things, hard for stocks, it makes things good for treasuries. And then yeah, again the cutting down agencies and things like that. It could be short term. Well, and and you kind of want that, like mo most good reforms. If you look at the history of reforms around the world, it's the same story of you know a bit of short-term pain. Well, sometimes actually significant short-term pain, and sometimes that short-term is a little bit longer than we think for long-term benefits. And you know, I I can't remember where I read it, but somebody said, the reason why they're called reforms is because, if they were easy, they'd already be called forms because they'd already be in place. It's like you need some kind of motivation or greater pain to trigger getting them into it. Um,
Not sure if you saw the other question there, Callum, about the long term or the exposure to 60% S&P 500 and 40% physical gold. Any thoughts on that?
oh yeah, so the 60/40 portfolio, but instead of having your 40 in treasuries, you're having the 40 in gold. I think, um, you know, if we look at the treasuries valuation chart and we went back to, you know, 2021 sort of period there, 2020, 21, um, treasuries were expensive back then. And from memory, I think my gold indicator was cheap back then. And so that would have been a, you know, really good decision back then. Um, and this kind of gets us into this idea that I've been sort of playing around with for a while is of smart diversification. So, a lot of attention goes on the 60 side of the portfolio. So, the growth side, but not so much attention goes on the 40%, the defensive side. And, you know, back in going into 2022, there was this kind of bad, pretty much the worst case scenario of both stocks and bonds being extreme expensive. And so if you're a 60/40 portfolio, you're basically 100% exposed to overvalued markets there. And, you couldn't have confidence on your 60 because it was at risk by being overvalued. And you couldn't even have confidence in your 40 because it was expensive. And so, um, smart diversification in my mind means being like, okay, what if we look at the set of diversifiers, uh, and if we think about the most basic one would be, um, government bonds, gold and cash. Um, if gold is really cheap and is kind of undervalued and stocks are very expensive, then you would definitely want to be into that. Putting your defensives into gold. If gold is expensive, treasury is cheap, then might have been the other way around. If both gold and treasuries were expensive, then it might be just cash to do that, perform that defensive role. So I think that the sort of long-winded answer is basically make sure that your defensive uh, side of the portfolio actually is defensive, and also look for the best forward-looking defensive option. I think the yeah, like gold is in an uptrend at the moment. It's in a bull market. There's no denying that. Um, I my concern would be that that might be yesterday's story, or at best, we're still in the middle of the story versus treasuries. We're kind of at the beginning of the story there. So yeah, I think definitely rethink the 40% of things.
It seems a pretty high exposure, doesn't it, to gold?
Well, if it makes sense, then it makes sense.
Yeah,
You know, um, 40% to treasuries when they were expensive was irresponsible and bad and turned out to be wrong. Commodities were the best one. I've got another chart with commodities on there, and they were actually cheap during that stage, and then in 2022, of course, we got a bunch of catalysts that kicked that into action. But the valuation clues were there if we wanted to look for them.
All right. Any other questions? Feel free to drop them in the chat, but that looks like that might be it there, Callum, and don't want to take up too much of your time. Really appreciate you coming on today and sharing your insights with us. It was, yeah, very valuable for me and hopefully for everyone else as well.
Yeah, my pleasure.
Awesome. So obviously, yeah, if you want to check out Callum, he's his Topdown Charts. Where's the best place on Twitter there, Callum? Or
Yeah, again, yes, if you just search up top-down charts, if you, I mean,
yeah,
it's your method of choice. If you like Twitter, I'm on Twitter. If you like email lists, I've got the free chart of the week there, and the weekly chart storm as well. So, yep.
awesome. Very good. Well, thanks again. We'll let you go, and yeah, appreciate everyone jumping on today and asking a few questions. And I'll get the replay out to anyone that didn't make it as well. So thanks again, Callum.